Is this a bubble? Is gold finally cracking? Is silver's wild ride finally over? Short answer, that's not what this is. What you are watching right now is a symptom of a deeply sick currency system trying to figure out who controls the price discovery mechanism for real money. OG John Prime here. If you're new here, you probably clicked this video with suspicion. Good. That means you're thinking. Keep it. I don't want blind followers. I want people who verify. Everything I say today, you can check yourself. Every number, every mechanism, every catalyst. Verifiable, public, open source. I'm not asking you to trust me. I'm asking you to verify. Let's talk about what healthy skepticism actually looks like in a market like this. When gold drops 2% on a Tuesday, the mainstream crowd says, the rally is over. When gold wipes those losses in a single session the very next morning, the same crowd goes silent. Neither crowd is verifying anything. Here's the discipline this channel is built on. We don't react to price. We trace the mechanism behind the price. We find the primary data, we pull the source, and we let the data speak. Comment gold below if you actually go verify anything from today's video. That's the filter. That tells me who's watching with their brain switched on. Now let's get to work. Check the Federal Reserve's official calendar at federalreserve.gov. Pull the January 27 to 28 meeting cycle. Read the minutes yourself when they drop. Don't wait for a pundit to summarize them. Read the primary document. Current prices. Gold spot is trading near $4,929 per ounce, recovering from Tuesday's collapse to the $4,841 region. That's a nearly 2-week low gold hit in a single Tuesday session, dropping more than 2%. Gold April futures are up approximately 0.9%, trading near $4,949. Silver is up nearly 3% intraday to around $75.59, clawing back from a more than 5% drop on Tuesday. The gold-to-silver ratio is sitting near 65 to 1. Watch that number. The US dollar index, the DXY, is hovering near 97. The 10-year Treasury yield has nudged up to 4.075%, typically a headwind for non-yielding metal. Yet gold is still recovering. Public, updated, verifiable. Pull these on Kitco, FX Street, or the CME directly. Here's what everyone is reaching for the wrong explanation on. The mainstream headline says gold dropped because safe haven demand faded. US-Iran nuclear talks showed some early progress. Risk appetite improved. Dollar strengthened. That's the surface layer. What's underneath is a completely different story. This isn't a bubble deflating. This is a paper market repricing around a physical market that it no longer fully controls. Gold and silver aren't signaling mania. They're signaling dysfunction. The dysfunction between what paper contracts say gold is worth and what actual physical metal is being bid for around the world. That gap keeps reasserting itself every time the paper complex tries to impose a ceiling. Now let's go layer by layer. Mechanism 1. The macro engine. The Federal Reserve held rates steady at the January 27 to 28 meeting, range of 3.5 to 3.75%. That was expected. What was not fully expected was the degree of internal division inside that room. Today's FOMC minutes drop at 2 PM Eastern. That's roughly 4 hours from when this video drops. This is the single most dangerous window for metals this week. Here's what everyone's missing about these minutes. The Fed is not a monolith right now. Chicago Fed President Austin Goolsbee has said publicly there could be several more rate cuts this year if inflation continues its decline toward 2%. Fed Governor Michael Barr, on the other hand, has signaled a rate reduction may not come for some time, given persistent inflation risks. That division inside the FOMC will be on full display in these minutes. Meanwhile, CPI for January came in at a 4-year low of 2.4%, cooling, not collapsing. January payrolls came in at 312,000 jobs added, with unemployment edging to 4.3%. Strong enough that the Fed has cover to stay patient. The result? Markets are pricing the first cut for June. Not now, not March. Two numbers you need to hold in your head. 2.4% CPI, 4.075% 10-year yield. Real yields remain meaningfully positive. That's a headwind for gold on paper. And yet gold just recovered 2 days of losses in one session. That tells you the physical bid is overriding the macro math. Check the CME FedWatch tool yourself for the current rate cut probability curve. It's public. It's updated in real time. Read the FX Street FOMC coverage from February 17 and 18. Pull the Natixis analyst note referenced in CNBC. Look up what Bernard Dada said about opportunistic buying below $4,900. Mechanism 2. The positioning story, and why the crowd is almost always wrong at the extremes. Here's what happened in late January. Gold hit an all-time high above $5,595. Silver hit $121. Then it crashed. Gold plunged more than 12% in a single session on January 30th. Silver dropped over 30%. This is not random. This is the mechanics of forced deleveraging. CME Group raised initial margin requirements for COMEX gold futures 6 times in the current cycle. 6 times. They started at 6% and have now pushed gold margins to 9%. Silver margins went from 11% to 18%. Hedge funds and large speculators were reported to have reduced net long positions by approximately 23% during the initial unwind. That's the crowd. That's managed money getting flushed out on margin calls. Don't trust the price action alone. Don't trust the headlines. Trust primary data. Pull the CFTC Commitment of Traders report at cftc.gov. Look at managed money net positioning in COMEX gold futures. See where those net longs went during the January spike and where they sit now. That data is published every Friday. It is free. It is public. The question right now is simple. After 6 margin hikes, after a 23% reduction in speculative length, is the crowd already gone from the long side? Because if they are, then a hawkish set of FOMC minutes today doesn't have the same paper army to sell into. Fewer speculative longs to shake out means less forced selling on any given catalyst. Think about that. And then separately, think about what happens when that positioning rebuilds. Watch the next Friday COT release. Compare managed money net length against where it stood at the January peak. That differential will tell you more than any analyst note. Mechanism 3. Physical versus paper. This is where it gets real. The CME Group margin increases exist because of what happened in January. Gold went from approximately $4,000 an ounce to over $5,500 in a historically compressed window. Silver went from around $50 to $121. Those are not speculative movements in isolation. Those moves had a physical demand engine underneath them. The Shanghai Gold Exchange and the Shanghai Futures Exchange, the SHFE, are currently closed for Lunar New Year through February 23rd. That means the single largest incremental source of physical demand on the planet is offline this week. Here's what that creates: a temporary vacuum in the arbitrage mechanism. Normally, Shanghai physical premiums pull Western paper prices upward when there's tightness. Right now, with Asian exchanges dark, that support pillar is absent. The Sprott Money COT analysis published in early January noted that physical delivery demand drove silver backwardation, spot prices above front-month futures, as far back as October 2nd last year. That is a signal of genuine physical stress, not speculation. India's gold imports in January alone hit 95 to 100 tons. Digital gold purchases in India surged 70% month over month to 2.6 tons. India's central bank, the Reserve Bank of India, added 0.13 tons in January, bringing total holdings to a record 880 tons, representing 17.2% of foreign reserves, an all-time high. The People's Bank of China extended gold purchases for the 15th consecutive month in January. Central banks don't buy paper promises. They buy allocated, audited, physically delivered gold. Now pull up the CME delivery statistics. Pull current COMEX registered gold inventory. Compare that to open interest. The ratio matters. When open interest divided by registered inventory starts stretching, that's a stress indicator. The manipulation window language you see on other channels, be careful with that. What the data shows is not necessarily coordinated crime. What it does show is a paper complex that sets prices on daily volume and a physical market that increasingly disagrees with those prices. That disagreement is what you are watching play out in real time today. Now the bear case. And I mean this. If you're here to have your bias confirmed, you're in the wrong place. This doesn't mean gold only goes up. Risk 1. The FOMC minutes drop at 2 p.m. Eastern today. If those minutes reveal a committee far more hawkish than the market expects, if members were arguing aggressively for a higher for longer posture, expressing real concern about re-acceleration of inflation, the dollar rallies hard, yields spike, and gold revisits the $4,841 low or worse by the weekly close. JP Morgan's analysts, while maintaining a bullish long-term view with a $5,000 average price target for year-end 2026, have acknowledged that the near-term environment is one of continued price discovery, as traders absorb higher capital costs from the margin increases. Risk 2. The paper control mechanism persists longer than physical buyers expect. 6 margin hikes in one cycle is extraordinary. If CME raises margins again, another round of forced selling wipes out the recovery entirely. This has happened twice already in February. Risk 3. Shanghai reopens on February 24th. That restart could trigger a violent snapback in either direction. If Chinese physical buyers don't return at the pace the bulls expect, the narrative of relentless Asian demand gets stress-tested fast. Risk 4. Technical resistance near $5,000 is significant. Gold has struggled to hold above that level. The psychologically important round number acts as a paper ceiling every time it approaches. Key support levels to know: $4,760 on the downside, $5,052 on the upside. If gold fails at $5,052, you're looking at a range-bound market waiting on the next catalyst. Watch Friday's PCE data. That is the Fed's preferred inflation gauge. If it comes in hot, June cut expectations collapse, the dollar rips, and metals get sold. Eyes open, no dogma. Rapid recap. Stay with me. Gold hit an all-time high above $5,595 in late January. Silver touched $121 per ounce. Both crashed violently. Gold fell more than 12% in one day. Silver fell over 30%. CME raised COMEX gold margins 6 times, from 6% to 9%. Silver margins went from 11% to 18%. Speculative longs were reduced by an estimated 23%. Tuesday, gold dropped more than 2% to $4,841. Wednesday morning, gold recovered to $4,929, nearly wiping 2 days of losses in one session. Silver recovered over 3% to $75.59. FOMC minutes from the January 27 to 28 meeting drop at 2 p.m. Eastern today. Fed rate range is currently 3.5 to 3.75%, held steady in January. Markets priced the first rate cut for June 2026. CPI came in at 2.4% in January, a 4-year low. January payrolls added 312,000 jobs, unemployment at 4.3%. India's central bank holds a record 880 tons of gold. PBoC extended purchases for 15 consecutive months. Shanghai exchanges are closed until February 24th. PCE data drops Friday. That's your next binary event. The crowd reduced their longs by 23%. The central banks didn't stop buying. That's the map.